There is a number sitting inside the COMEX silver exchange right now that every investor who holds silver, every investor who holds gold, and every investor who owns a solar company, an electric vehicle stock, or any asset connected to the green energy transition needs to understand before the May delivery cycle arrives. The number is 13.4. That is the coverage ratio, the percentage of physical silver actually available for delivery against the futures contracts that claim to represent it. 76.88 million ounces of registered silver sitting in approved vaults in northern New Jersey. 575 million ounces of open interest on silver futures contracts making claims against that metal. 13.4% coverage. For every 100 ounces of silver that has been promised on paper, there are 13 ounces of physical metal available to honor that promise. The system has operated for decades on a single assumption. That assumption is that not everyone will ask for their silver at the same time. In January 2026, that assumption began failing. In 7 days, 33.45 million ounces were physically withdrawn from COMEX registered inventory. 26% of the registered pool gone in a single week. December 2025 produced 65 million ounces in physical deliveries, a single-month record that the exchange had never previously approached. All of 2025 settled 474 million ounces of physical silver. In 2024, the same exchange settled 203 million ounces, the number more than doubled in a single calendar year without a headline event most people could name. And now, with coverage at 13.4%, the May 2026 delivery cycle is approaching. The CFTC, the regulator with access to the actual position data and inventory flows, has proposed cutting spot month position limits from 6,000 to 5,000 contracts. They are preparing circuit breakers. When regulators prepare circuit breakers before a squeeze rather than after one, it tells you something important about what the people with access to the real data expect to happen next. I have been watching commodity markets navigate supply and demand dislocations for over 40 years. And what I am going to show you today is not speculation. It is a mechanical sequence that is already in motion, documented in customs records, exchange data, and regulatory filings that has produced the conditions for what I believe will be the most significant repricing of a monetary and industrial metal since the Hunt brothers drove silver to $50 in 1980. Except this time, the Hunt brothers are not two men from Texas. They are the entire industrial economy of the planet. Subscribe now. Here is the mechanism. Write this down because there are 4 forces operating simultaneously in the silver market right now, and each one alone would be sufficient to tighten the physical supply. Together, they are producing a supply crisis that has no historical precedent in the modern silver market. Force 1. 6 consecutive years of structural supply deficit. The Silver Institute, working with London-based consultancy Metals Focus, projects a 67 million ounce shortfall in 2026, with total demand once again outstripping total supply. This is the 6th consecutive year of deficit. The cumulative shortfall between 2021 and 2025 is estimated at approximately 820 million ounces, nearly equivalent to an entire year of global mine production. Gone. Not recycled, not recovered, consumed by solar panels, by electric vehicles, by AI data center cooling systems, by defense electronics, by semiconductors, by every advanced technology application that requires silver, because silver is the best electrical conductor at room temperature, and no material science advance has produced a viable substitute at scale. Silver mine supply is not responding to the price signal because silver cannot respond to the price signal the way most commodities can. Approximately 70% of silver is mined as a byproduct of other metals: copper, zinc, lead. The economics of silver production are largely determined by the economics of the metals it accompanies. You cannot simply decide to produce more silver in response to a price signal without first deciding to produce more copper or zinc. And the global copper and zinc production decisions are driven by factors that have nothing to do with the silver market. Force 1 is a structural deficit that is now in its 6th consecutive year with no supply response mechanism capable of closing it. Force 2, China's strategic silver grab. On January 1, 2026, China implemented new export restrictions on refined silver, requiring government licenses from the Ministry of Commerce for any outbound shipment. Only large state-approved companies with annual production capacity of at least 80 tons qualify. These requirements effectively block hundreds of smaller and mid-size exporters who have been the primary suppliers to global industrial users and refiners for decades. China controls approximately 60% of global silver refining capacity. When China restricts silver exports, it is not adjusting a trade policy, it is reclassifying silver from a commodity to a strategic material, the same category as rare earths, tungsten, and antimony. The same strategic logic that China applied to rare earths in 2010 and to gallium and germanium in 2023. China has decided that the silver flowing through its refineries should serve Chinese industrial demand first and the global market second. And simultaneously, while restricting outbound flows, China is importing silver at record levels. In the first 2 months of 2026 alone, China pulled in over 790 tons of silver, including nearly 470 tons in February, the highest ever for that month, according to Chinese customs data. China is hoarding domestically while restricting exports. This is not an accident. China's solar manufacturing requires silver. China's electric vehicle production requires silver. China's semiconductor fabrication requires silver, and China's leadership has made the strategic calculation that in a world of increasing geopolitical fragmentation and resource competition, controlling the silver supply chain is a national security objective, not merely an economic one. Force 2 has fragmented the global silver market into isolated regional pools, as Goldman Sachs analysts warned in January, transforming what was a smooth integrated global market into one prone to sharp localized price swings, where different regions pay fundamentally different prices for the same metal. Force 3, the physical run on the paper silver system. For decades, global silver price discovery was controlled by futures traders on the COMEX in New York and the LBMA in London. Trading volumes in paper silver dwarfed the total stock of above-ground silver. At its peak, the notional ratio of paper silver claims to physical silver reached 356 to 1. This system operated on the assumption that the paper claims would never all be presented for physical settlement simultaneously. That assumption is failing. COMEX registered inventory has fallen approximately 75% from its 2020 peak. LBMA vaults have lost around 40% of their holdings. Shanghai inventories are at their lowest level in a decade. The 3 largest silver inventory pools in the world are draining simultaneously. 15 consecutive months through early 2026, physical silver left COMEX warehouses at volumes the exchange had never previously processed. Silver lease rates, the cost of borrowing physical metal for short-term delivery, spiked to 8%, a level that signals genuine scarcity in the physical market rather than speculative pricing in the paper market. And in January 2026, JP Morgan issued 99% of 8.1 million ounces in a single day's delivery notices, acting as the primary seller, the metal provider, in a delivery session where open interest increased by nearly 1,500 contracts simultaneously. New buyers were arriving faster than metal was clearing. The people demanding physical delivery at COMEX are not industrial users. Industrial users buy refined silver directly from producers and refiners. They do not use the COMEX delivery mechanism. The entities standing for physical delivery at COMEX are institutional investors who have concluded that the paper claim to silver is not the same thing as silver and who are converting one into the other before the conversion becomes more difficult. That is the definition of a bank run, not on a bank, on a commodity exchange. Force 4, the industrial demand that cannot be substituted. Silver goes into every solar panel manufactured anywhere in the world. Each photovoltaic cell requires silver paste as a conductor. Solar panel installations globally are growing at double-digit rates annually. The International Energy Agency projects that solar will provide 33% of global electricity generation by 2030, up from approximately 12% today. Every percentage point of that growth requires silver that cannot be replaced by any other material without significant performance degradation. Electric vehicles require between 60 and 80 grams of silver per vehicle, compared to 15 to 20 grams in a conventional internal combustion engine car. EV production is growing. AI data centers require silver in cooling systems, in connectors, in the high-frequency signal transmission applications where silver's conductivity advantages over copper become critical. Defense electronics, satellite communications, advanced semiconductors, all of them require silver, and none of them are price-sensitive buyers. The solar panel manufacturer is not choosing between silver at $60 per ounce and silver at $120 per ounce. The silver cost is a fraction of the total system cost. The manufacturer is choosing between having silver and not being able to make solar panels. That is inelastic demand, structural, growing, and impossible to substitute at scale. Now I want to show you what these four forces together have done to the physical market data, because the numbers tell a story that is more extreme than almost anything currently being reported in mainstream financial coverage of the silver market. COMEX registered inventory stands at 76.88 million ounces as of mid-April 2026. Open interest on silver futures stands at 575 million ounces. Coverage ratio, 13.4%. To put that in context, consider what happened in the nickel market in March 2022. The London Metal Exchange had to suspend nickel trading and cancel $4 billion in trades when a short squeeze drove prices to $100,000 per ton. The immediate cause was a large short position that could not be covered when the physical nickel market tightened. The COMEX silver market currently has a coverage ratio of 13.4% in a physical market that is experiencing its sixth consecutive year of structural deficit, with China having restricted the export of 60% of global refining capacity, with registered inventories having fallen 75% from their 2020 peak, with physical lease rates at 8%, and with the CFTC proposing circuit breakers before the squeeze rather than after it. The CFTC is not implementing position limit reductions because they believe the silver market is stable. They are implementing them because they believe the silver market is not stable, and they want circuit breakers in place before the May delivery cycle test the 13.4% coverage ratio against 575 million ounces of open interest. There is one additional data point that I find the most compelling single indicator of where the physical silver price is actually headed. Silver mining equity producers and precious metal royalty companies, the businesses whose entire enterprise value is determined by what they can sell silver for over their mine lives, are currently pricing an average silver price of $122 per ounce. Not the futures price, not the paper COMEX price. The price embedded in their equity valuations by the investors who have studied their ore reserves, their production costs, and their long-term supply contracts. $122 against a current spot price that has recovered to approximately $76 from its January all-time high of $121.62. The equity market is saying the paper price is wrong, and the equity market has access to the same physical supply data, the same COMEX inventory numbers, the same China export restriction details, the same structural deficit projections that I have just described. Let me now address the counterargument directly, because it is being made by serious people and it deserves a serious answer. The counterargument is this: the silver market has been in structural deficit for 5, now 6 consecutive years. Inventories have been declining for years, and yet silver has not broken out sustainably to triple-digit prices. The physical deficit is real, but it is being managed by drawing down above-ground inventory. Industrial users are finding workarounds. Substitution is gradually occurring in less demanding applications. And the paper market, which determines the marginal price, is not constrained by physical inventory in the short term because most futures contracts are settled in cash rather than physical metal. Therefore, the structural deficit does not produce the supply crisis that the physical inventory data seems to imply. This argument was correct through 2025. It is becoming less correct in 2026, and here is the specific reason. The argument assumes that above-ground inventory drawdown can continue indefinitely as the buffer between structural deficit and market disruption. But inventory is not infinite. COMEX registered inventory has fallen 75% from its 2020 peak. When registered inventory falls 75% over 5 years in a market running structural deficit, the pace of drawdown is not linear. It accelerates as the remaining inventory becomes harder to source, as the premium required to move eligible metal into the registered category rises, and as the geographic fragmentation caused by China's export restrictions creates regional supply pools that cannot easily substitute for each other. The coverage ratio at 13.4% is not a static data point, it is a dynamic one. And its direction of travel, driven by 6 consecutive years of deficit, by China's export restrictions, by the record physical delivery volumes at COMEX in 2025 and early 2026, is toward a level at which the paper-silver system cannot credibly claim to represent a market in which physical delivery is available to all contract holders simultaneously. When the paper claim and the physical reality diverge beyond the market's ability to pretend they are the same thing, price discovery shifts from the futures exchange to the physical market, and the physical market is currently clearing at prices that vary by geography, by delivery timeline, and by buyer priority in ways that a unified futures price cannot capture. Let me close with the 2 things I am watching most closely to determine when the paper silver price converges with the physical silver price at the scale that the structural data implies. The first is the May 2026 COMEX delivery cycle. The March delivery cycle passed with elevated but manageable delivery volumes. The May cycle will arrive with a coverage ratio of 13.4% and open interest of 575 million ounces. The ratio of open interest to registered inventory is the most direct measure of delivery stress. When that ratio deteriorates further into May, when delivery demands approach the coverage threshold in a way the exchange cannot easily manage through reclassifying eligible inventory, the paper price will be forced to reflect the physical reality rather than the notional futures market. Watch the registered inventory number daily as May approaches. When it falls below 50 million ounces, the coverage ratio enters territory the exchange has not navigated before at current open interest levels. The second is the gold to silver ratio, currently at approximately 62, meaning 1 ounce of gold buys 62 ounces of silver. The historical average of this ratio is approximately 55. At the peak of the 2020 COVID crisis, the ratio reached 123, its most extreme reading in modern history. Since 2020, the ratio has been compressing, meaning silver has been outperforming gold on a relative basis. In every previous major gold bull market, the gold to silver ratio has compressed dramatically in the later phases of the move. In 1979 and 1980, the ratio fell from approximately 40 to 16 as silver's monetary and industrial properties both activated simultaneously. When the gold to silver ratio falls below 50, it historically signals that silver's outperformance of gold has begun in earnest. The current reading of 62 is not at the extreme level of compression that signals the full acceleration, but the direction of travel, driven by 6 consecutive years of silver structural deficit against a gold market that does not face the same physical scarcity dynamics, is toward compression. And when that compression occurs against the backdrop of the COMEX coverage ratio at 13.4%, of China's strategic export restrictions, of industrial demand from solar, EV, and AI that cannot be substituted, and of silver mining equities pricing $122, the convergence of the paper price and the physical price will not be gradual. It will be violent. There are 2 types of investors watching the COMEX silver data right now. The first type sees $76 per ounce, sees that silver is down from its January high of $121, sees the short-term paper market trading lower on the same oil-driven dollar yield mechanism that is suppressing gold, and concludes that the silver thesis has not materialized. They do not track the coverage ratio. They do not read the Ministry of Finance customs data, showing China importing 790 tons in 2 months while restricting exports. They do not watch the CFTC position limit proposals being issued before the squeeze rather than after. They are reading the paper price and concluding it tells them everything they need to know about a market in which the paper price and the physical reality have diverged more dramatically than at any point in the modern history of silver trading. The second type understands that in a market with 13.4% physical coverage, 6 consecutive years of structural deficit, China controlling 60% of refining capacity and restricting exports, COMEX registered inventory down 75%, and silver mining equities pricing $122. The paper price at 76 is not the market clearing price for physical silver. It is the price of a financial claim to silver in a system that has not yet been forced to fully honor all of those claims simultaneously. The May delivery cycle will test that system. The coverage ratio will either hold or it will not. And if it does not hold, the price discovery mechanism that has set the silver price for decades will shift from the futures exchange to the physical market. Watch the registered inventory. Watch the coverage ratio. Watch the gold to silver ratio below 50 and understand that the mechanism producing the 13.4% coverage number has been building for 6 consecutive years. It was not created by a single event, and it will not be resolved by a single event. It will resolve when the paper claims and the physical reality can no longer coexist at the same price. Most investors will not understand that moment until after it arrives. Now you do.